Hi everyone, I'm your host Michael and welcome back to my channel, The Money Blueprint. In today's video, we're going to break down two of the most common terms you'll hear in investing, bull markets and bear markets. We'll explain what each one means, how they differ, and look at a few examples from history so that you can see these concepts in action. Whether you're new to investing or just curious about how market moods affect prices, you're in the right place. So let's get started. Let's start with the basics. Firstly, a bull market is a period when prices in a market, such as stocks or cryptocurrencies, are rising over time. Imagine a bull charging forward with its horns up. That's the energy we see in a bull market. Investor optimism is high and people expect prices to keep climbing. One of the most famous bull markets in recent memory occurred in the cryptocurrency world. Back in 2017, Bitcoin started the year trading around $1,000. As more people recognized its potential, investor enthusiasm built up, and by the end of 2017, Bitcoin neared $20,000. This dramatic surge is a classic bull run driven by optimism, media hype, and increasing adoption. Another example is from the traditional stock market. During the mid-2000s, global stock markets experienced several years of steadily rising prices. Investors were confident about economic growth and corporate earnings, fueling a protracted period of rising share prices. In both cases, the upward momentum was self-reinforcing. Rising prices led to more buying, which in turn pushed prices even higher. On the flip side, a bear market is when the prices are falling consistently. Think of a bear swiping downward with its paws. In a bear market, fear and pessimism tend to dominate and investors start selling off their assets to avoid losses. A well-known bear market took place during the Great Depression in 1929. Even though this was probably well before many of you were born, the Great Depression saw a dramatic stock market crash and prolonged economic hardship leading to years of falling prices. Investor confidence nearly evaporated as people lost trust in the economic system. More recently, the global financial crisis of 2008 was also considered a bear market. It was caused by a collapse in the housing market and risky financial practices that shook investor confidence around the world. Stock prices tumbled, and the fear of further losses led many to sell off their investments, deepening the downturn. These examples highlight the common theme in bear markets. External shocks or overvalued conditions trigger a spiral of pessimism and price declines. In simple terms, bull markets are marked by confidence and rising prices, while bear markets are characterized by caution or gloom and falling prices. So, what is it that really differentiates a bull market from a bear market? The first major difference is investor sentiment. In a bull market, investors are optimistic. They buy expecting further price increases, leading to a self-perpetuating cycle of rising prices. In a bear market, investors are pessimistic. The fear of continuing losses drives them to sell, which often causes prices to fall even further. Another key difference is the overall economic outlook. Bull markets usually coincide with a growing economy, low unemployment, and high consumer confidence, whereas bear markets, on the other hand, usually appear during economic slowdowns or recessions. Lastly, market activity tends to differ. During bull markets, trading volumes are often high as more people join in to catch the upward momentum. In bear markets, trading can be more volatile or even subdued as investors hold back out of uncertainty and risk aversion. Now let's dive a bit deeper into what drives these market phases on a broader scale. First, let's look at the economic indicators and news. In bull markets, positive GDP growth, increasing corporate profits, and favorable government policies can all fuel a bull market. When investors read good news about the economy or a specific industry, they are likely to buy, pushing prices up. Whereas in bear markets, negative economic news such as rising unemployment, economic contractions, or global crises can trigger a bear market. When bad news dominates headlines, investors often rush to sell to avoid or minimize losses. Second, we should consider market psychology and feedback loops. In bull markets, when prices start rising, it creates a feedback loop. Optimism leads to more buying, which leads to even higher prices. Whereas in bear markets, it's the opposite. A few bad days or negative reports can lead to panic selling. As more people sell, prices drop further, amplifying fear and causing even more selling. The third factor to consider is the valuation and overextension. In bull markets, sometimes prices can become overextended or overhyped, driven by speculation rather than fundamentals. Eventually, this can and usually does lead to corrections. Whereas in bear markets, falling prices can, in some cases, create opportunities where assets become undervalued relative to their true worth. Savvy investors might look at these as buying opportunities, betting on a future turnaround. These factors interact to create the distinct climate of optimism or pessimism in each type of market. Understanding how to identify these market conditions is essential for making informed investment decisions. So how do you recognize and react to bull and bear markets? First, let's take a look at the technical indicators. Many investors use charts and indicators, like moving averages or relative strength index, RSI, to help recognize market trends. For example, sustained price increases with high trading volumes might signal a bull market, whereas a downward trend combined with high volatility might indicate a bear market. Staying informed is just as essential as the technical indicators. Follow economic news, corporate earnings reports, and geopolitical events. Often, the market's movement is a reflection of these real-world events and will rise and fall with these changes. Thirdly, you need to mind your emotions. Both bull and bear markets can trigger strong emotions. It is important not to get caught up in the hype of a bull market or the panic of a bear market. Having a clear, long-term plan can help you navigate these cycles more calmly and help you make sensible decisions relating to your investments. For instance, during the bullish run in 2017, many investors jumped in, driven by the excitement, while the sudden market drop during the early days of the COVID-19 pandemic in 2020 caught many off guard. Learning from these examples can help you develop a more balanced approach. Now let's talk about some basic strategies you can use in both bull and bear markets. In a bull market, consider riding the momentum while being cautious. It can be wise to set stop-loss orders to protect your gains. Diversifying your investments may also be a wise idea so that you're not overly exposed to a single asset, even during a run. In a bear market, it's important to avoid panic selling. Bear markets often create buying opportunities for long-term investors. Diversification and a focus on fundamentals can help tide you over the downturn. You should also regularly review your portfolio and be ready to adjust your strategy if market conditions shift. By understanding how these strategies can be applied in different market conditions, you put yourself in a better position to manage risk and capitalize on opportunities. Put your thoughts in the comments on whether you would like me to do a video talking about the strategies in more detail. To wrap things up, a bull market is all about optimism, rising prices, and growing confidence, all factors that push investors to buy. Whereas a bear market is characterized by pessimism, falling prices, and caution, often fueled by negative economic conditions or market sentiment. Recognizing the driving forces behind these markets and knowing how to respond can help you make smarter, more informed decisions. I hope this comparison has cleared things up for you and helped understand the bull and bear markets. If you found this video helpful, Please hit the like button and subscribe for more easy-to-understand videos on investments and strategies. Leave your questions or comments below. I'd love to hear your thoughts on how you navigate bull and bear markets. My name is Michael, and thank you for watching the Money Blueprint today. I look forward to seeing you in the next video in this series of Crypto for Beginners.